Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Fortuna silver mine stock so we can determine if it's a buy or a sell. Fortuna is a precious metals mining company with operations in Argentina, Burkina Faso, Mexico, and Peru. Its main focus is producing silver and gold. The company is headquartered in Vancouver, British Columbia, Canada, and was founded in 1990. Let's get started with the model. This is a small cap company, 1 billion market cap. They're trading at $3.50 a share, and they have 297 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Even though their revenue is growing, they still have negative free cash flow each year. They are investing a lot back into their business to acquire new assets, new silver and gold mines. Net income is the profit or loss on the income statement. It's revenue minus expenses. That is positive in 19, 20, and 21, negative in 2022 due to write-downs. Revenue is a sales for the company, and that looks really good, from 250 million to nearly 700 million. The company did recently release their first quarter earnings, and this is their income statement, the first quarter of 2023 versus the first quarter of 2022. Revenue is down a little bit from 182 million to 176 million. I'll show you a breakdown of this revenue so you know what it is. Of the 176 million in revenue, 26 million from their mines in Peru, 43 million in Mexico, 51 million in Argentina, and 56 million in Burkina Faso. That's a country in West Africa. Not sure if you're familiar with Ghana, but they border Ghana and several other countries. They did have a similar amount of revenue in the first quarter of 2022 by location. Of the 176 million of revenue, 42 million is from silver gold concentrates, 12.6 million from silver lead concentrates, 12.5 million from zinc. Gold Dior is their biggest, 107 million. I'll explain what this means if you're not too sure. If you ever pull a metal, any type of precious metal, it's usually not pure, that metal. It's usually combined with a lot of other metals. For instance, you can find silver in lead, zinc, gold, and copper ore deposits. And it's pretty common for gold and silver to be extracted together from the same ore. And they do some business in zinc. Zinc is mainly used to coat steel and iron, mainly to protect it from rust and corrosion. When you hear the term gold Dior, that's a bar of precious metals. It's usually made up of silver and gold, but it's not pure gold. Even though when you hear gold Dior, you think it's pure gold, but it's not. On average, a gold Dior bar would consist of 50 to 75% of pure gold. Obviously, the more gold, the more valuable it is. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. All the expenses to pull the precious metal. It takes a lot of man hours, a lot of machinery. They have to pay for the rights to access that location so they can pull the ore from the ground. They can't just go there and start pulling precious metal. They would get in a lot of trouble. So their gross profit is 40 million, down a lot from 63 million. Then they have general and admin expenses, like the salary for the CEO, that would be in there. They might have a gain or loss in foreign exchange rates. That was 1.6 million. Their operating expenses are 16 million, down a lot from last year of 23 million. So their operating income is 24 million, down from 41 million. They pay 2.6 million of interest on their debt, 9 million of taxes. So their net income is 12 million, down from 27 million. Their earnings per share last year in the first quarter was 9 cents. This year it's 4 cents. They do have less shares outstanding, so they are buying back stock. They had 292 million last year, 290 million this year. Let's look at the capital structure. 1.2 billion of equity, 240 million of debt. They're 84% equity, 16% debt. Their net debt is 160 million, so they have 81 million of cash on their balance sheet. I gave them a WACC of 11%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.2 billion. We divide that by 300 million shares. And we get a calculated stock price of 408. They're trading at 350, so they're trading at a 14% discount. It's a buy according to the model. Simply Wall Street's at 452. They say the stock is 23% undervalued. Two analysts priced this stock, one at 483, the other at 520. Another 5 analysts priced this stock, and the average price target is 463. They say it's 32% undervalued. This is where the stock has been trading since they IPO'd, so you can see it's all over the place. Its lowest point was right during the Great Recession. At the end of 2008, it looks like it was about 25 cents. It is hard to tell on this chart. It peaked in 2016 at almost $10. 25 cents to $10, that's a 40x growth. Right in the beginning of COVID in March 2020, it fell below $2. Then it rose to $8.50, then fell below $3. So this is all over the place, this stock. This bottom chart pinpoints their quarterly revenue. In the fourth quarter of 2022, their revenue was $165 million. The website I pulled this from didn't have the first quarter revenue, but it looks like it almost got up to $200 million at its highest. It was around $80 million in 2018. It did steadily grow from 2010 to 2018, then really shot up in 2020. But their revenue doesn't really track their stock price, so you can't use that as an indicator. If they were a more mature company, then you might be able to. Since this company IPO'd, their stock price is up about 87%. And that's exactly where silver is, up 87% since this company IPO'd. Gold is up 200% in that same time period. But you can see the blue line is Fortuna, and it's much more volatile than silver and gold. The pinkish line is silver, and you can see it's a lot more steady than Fortuna. Fortuna looks like a heartbeat. It goes way up, way down, way up, way down. There are 5 companies in the same industry as Fortuna, and if Fortuna has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend the most in CapEx of the 5 companies. All the companies have a good debt to equity ratio. For every dollar of equity, Fortuna has 20 cents of debt. They don't pay a dividend. 3 companies on this list do pay a dividend. Their free cash flow is the median. They rank 4th in market cap of the 5 companies. They do have a much better price to book and price to sales than the median, but we can't look at their PE or price to free cash flow. They rank 2nd in revenue of the 5 companies, and their 5-year annual revenue growth rate is strong at 21%. To summarize, I have them trading at a 14% discount. They've been around 33 years. They seem to be growing. They haven't generated positive free cash flow, but I know that does take time. If you want to make money in the short term, you could do it on this stock because it does move around a lot. Of course, you have to time it right. For a long-term hold, I'm not too sure. I rank their free cash flow as 1 out of 10, their revenue 6 out of 10, and their ratio is 4 to 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to become a member, click on the link in the description below. Thanks for watching.